Hey guys, Mike here. So, what a day in the market we had here, and this is a boatload of information I'm about to throw at you. Some of it probably will surprise you like it did me, but I'm going to try to help it make sense for you and everything. And understand, I want to clear one thing up. This is a Chicago Bears hat. I'm wearing the hat because I had a small accident yesterday when I was doing something, which is just a stupid accident. And without the hat, it looks like I have a bug on my forehead. So, I decided to wear the Bears hat. Yes, I am a Chicago Bears fan. I'm from Alabama. We had no pro sports, and that's how I became a Bears fan because I love Walter Payton in the early 80s. He was the man. Little did I know after we won the Super Bowl in 85, it was going to be a long road ahead for me. So, Bears fans know what I'm talking about. But I got hope now, so we'll see. But anyway, just want to clear that up for you guys. But this one right here, I normally don't show you interviews, very seldom. But I ran across one last night. I listened to it 3 times because anything can tell me what's going on ahead of time. I like to know. And this one right here is with a CEO who owns a lot of companies, right? And so what do we talk about? Consumer spending, right? When are we going to stop spending? When's there going to be a slowdown? When's it going to take effect? When's all that money that everybody got from 2020 going to start dissipating and things like that? Well, this man tells you. That's why I normally would say, but I'm telling you, I'm going to let you listen to the whole thing. It's a couple minutes. Just listen to it. It's very crucial. And then right after that, another interview came out this morning kind of talking about the same thing. It's a 30-second clip. And she backs up another CEO, what this other CEO is saying, right? And remember, CEOs, unlike Wall Street people, have nothing to win by saying what these people are about to say. Okay, it's actually a lose-lose for them. But then I'll go into some data that was stunning. One of the members shared one of these pieces of data, and it was just stunning. I was like, wow, what a shift we have seen. So pay attention to this real quick, and I'll catch you on the flip side.
Your next guest is at the helm of restaurant giant Landry's. They own a ton of restaurants, Del Frisco's, Morton's, Mastro's, the Chart House, and many, many more. Joining us now is Landry's owner, Tillman Fertitta, also owns the Golden Nugget Casino chain, the app, the Post Oak Hotel in Houston, by the way, one of the best, if not the best in America, Tillman, and the Houston Rockets, as well as the Montage in Laguna Beach. And that's all the time we have for the interview. I'm kidding. Tillman, it's good to have you back on the program. You and I have talked forever about this. Is there any sign of any type of inflation, whether it's beef or labor or booze or whatever, starting to moderate or even come down?
It is starting to come down just a little bit right now. But you just showed it. If you don't have herds, you're not going to get beef. And as we look into the future right now, the herd is shrinking, and therefore beef prices are not going to come down unless we go into such a pullback that people just aren't out ordering whatsoever.
We just heard our return to office statistics, and I don't want to get into pandemic arguments because it generates all kinds of just debate on stuff that we're not trying to talk about. But I've visited you in Houston many times, in the last couple of years, and Texas maybe opened up earlier, and there were 2-hour waits at restaurants when things in New York were still closed. You've got your finger, in Vegas and New York and Houston and Beverly Hills and whatever. Is everything kind of back in many places, or are you still starting, like we just showed in Manhattan on a Friday, it's still weak?
Well, it is weak on a Friday lunch and a Thursday lunch. But don't forget, everybody in the consumer business had the best years they ever had when 21 and 22 rolled around because there was so much stimulus money out there. And so you weren't having the business meetings, but the consumer was going out on their own and spending money. And all that business is now pulled back. And it's going to get worse now when all these people have to start. You're taking millions of people that are in the workforce that are educated that now are going to have to start paying their student loans again. So you're going to continue to see a huge pullback as we go into the fall and companies continue to struggle. And second quarter numbers for consumer companies is not going to be good. And you can just bank that one.
I thought you were supposed to be optimistic.
I am optimistic, but it has slowed down.
How much?
Traffic is off in restaurants and casinos, 3.5% to 4%. Regionally across the country, I think the Strip in Vegas is going to be a little bit stronger because they're getting so many corporate meetings and business conventions. I look for the Strip in Vegas to be a little bit of an outlier compared to the regionals around the United States. but your restaurants are still slowing down and things are not going to be as good.
That's really interesting because, so much of the official economic data, Tillman, that we get and report on at CNBC is a month or 2 months old. We say, oh, the retail sales numbers for, March were good. You're getting, I know because I've seen your staff, you're getting like hour to hour and daily reports. So what you're saying is, it's maybe minute by minute knowing you. So we're starting to see things roll over, and maybe some of the data that we've got from a month or two ago just may not be as reflective of the real situation today.
You're exactly right. Y'all are looking at data that is produced usually a few weeks after the last month. And when you look at a trailing 12, the trend is not your friend right now when it comes to anybody that's in the high-end goods, especially the high-end restaurants. Fast casual is still doing okay. Even casual is doing okay. But your expensive restaurants, your expensive goods in your malls and your high-end stores are definitely feeling it right now. And I truly believe it's the stimulus money. There was so much stimulus money out there that people went out and bought objects and meals and things that they normally did not buy.
And so hopefully that makes sense. But here, this other CEO backs it up with this.
Well, we saw consumer spend decelerate toward the end of the quarter, macro pressures increasing on consumers, lower tax refunds, the regional bank failures. I think continued narrative from the Fed that they're trying to get inflation under control by creating a higher unemployment rate. All of these things have an impact on consumer spend. And so we saw that impact make its way up the value chain a bit.
And guys, before we continue, if you're getting anything out of this, please hit that thumbs up down there. I really appreciate it. And if you like the material here and the videos, think about subscribing. And so, yeah, they're seeing a slowdown at the top end stuff, right? Which is usually what's going to go first, okay? And so now we got to see how that filters down into everyday type, I guess, the McDonald's and stuff like that we do and everything. But, it makes sense what he's saying. They obviously got the data, what we get is delayed data. What they get is pretty much every day or every week. And so they're up to date on it. So makes sense. So let me know in the comments what you got of that. What else did you get out of that? What else did I get out of that? Another shortage. What we've been talking about. We talked about the three, supply demand shortages when it comes to energy, employment, and housing. Now we're going to have one in beef, I guess, or have had one in beef. I'm not in the beef business, but that's great to hear. And I'll show you some data either tomorrow or Saturday. Kind of shows how that actually makes sense, right? Now that leads us into the market, not the economy, the market part of data. And boy, has things changed in a week. But it should help explain a lot. And this is the AAII members and how they feel about the stock market 6 months from now. So sentiment, right? And look at that from 531 to 67. The bulls ended up increasing the bullishness from 30 to 45 almost. Look at the bears going down from 38 to 24. And then right in the middle stayed about the same. It decreased by about 3%. But this is in a week. Like, this is the biggest jump I've seen in a long time, man. But guess what? It explains a bunch of things. It explains this right here. The call buying on the SPX. It record highs, and it just keeps setting new record after new record after new record, which of course keeps driving these markets up higher, and it keeps it from falling, right? That's what keeps happening, because now when they're buying the calls, remember the market makers are selling them, and they're usually having to buy the stock to hedge, and so that's what's keeping it up. And we'll talk about that in just a minute. But, when you look at the S&P, what's happening right now? It's cooling up. It's consolidating. And we've seen this multiple times already, right? And so when it does this right here, it's going to make a move in either direction. It's either consolidation or accumulation, right? Put in the comments which one you think this is. And because remember, we're going to discuss in a second, but when you see when it accumulates like this for a longer period of time, whether it's days, weeks, whatever, there's usually a big move that comes, and you can see it can go in either direction right now. So the question is it going to move down, fill this gap right here, or are we finally going to sit there and head up and break the August highs on the S&P, which is 432-ish, right? And so looking at this right here, now this is data that's important, okay? Percentage of S&P 500 market cap, top 5 stocks. So right now, that is Apple, Microsoft, Amazon, Nvidia, and Alphabet. They make up 1/4 of this index, right? If we're talking about going to 432 here. You put in the top 10 stocks. You're going to add in Meta, Berkshire Hathaway, Tesla, United Healthcare, ExxonMobil. So you got other industries competing, right? Now, all of a sudden, you're at almost 35% with 10 stocks. So it's 490 out of, 10 out of the 500, excuse me. So 490 stocks make up a whopping 65%. And then, of course, the top 10 make up 35%. That has to change, right? That has to absolutely change. And that's called market breadth. I'm going to keep track of that for us because we have to track that. If we're in a real bull market, you have to have breadth improve. And the theory goes, price moves up. You have a small basket of stocks that will pull the market up. Eventually, that will change sentiment because it will hold it up there and keep moving it up because they're so heavily weighted. And then the laggards will catch up. That's the theory, at least. We'll see if that happens. You go to the NASDAQ 100. How many stocks are above the August highs, for example? Let's just use August. And I found this chart for you. And it's 52%, right? So a big difference on that. And so as you obviously eclipse one high after the other, which that's what we've been doing on NASDAQ 100, you start to build momentum, you start to build more breadth in the market, that kind of stuff, right? And the other thing I was looking for, I don't know about you, and I meant to mention this yesterday, I wanted to see if the dip buyers come in, right? And so they did in full force. All those stocks are beat down, NVIDIA, Shop, Roblox, ARK, you name it. And if we scroll up, you'll see, I mean, you got the other stocks, all your Chinese stocks ended up moving up. Remember, they were beat down yesterday after the slowing economy and stuff like that in China, or after data came out that their economy is slowing down and stuff. And then you move up to your software stocks like the Palantirs, Datadogs, all this stuff, and you end up sitting there having them have a big move up as well. So dip buyers are still strong when it comes to technology. Now, one thing we're going to have to see here, and I'll talk about this a little bit, is you're seeing this huge variation right now in the earnings per share forecast coming up here in the second quarter for the IWM stocks and then the NASDAQ 100, right? And so that is a big, big difference. And this is what I was talking about. And the reason why this is because this is not a good environment with these high rates and stuff that may be held there for a long time with higher inflation for the smaller cap stocks, right? And the reason why it's important is because you want to know, is this an actual rotation or is this just a bounce from those excessive charts I showed you where the SPY was just outperforming handily, or the NASDAQ versus the IWM was at all-time highs and all this other stuff. And again, that's why I said, is this rotation real? We got to look at it because, 1 or 2 days don't make a pattern, right, or a rotation. So we got to pay attention to that. And the IWM was red today, but I did make some post-it notes because I want to make sure I don't forget this. Because I understand when it comes to the EPS and all that stuff, fundamentals right now checked out. We all know that. I think we all agree, right? In 2020, 2021, same thing happened. Remember how many times you shook your head going, how high can this stock go? Should I be selling or holding? This thing's ridiculous, right? But it kept going. 2022, all of a sudden, valuations mattered. Not when I say matter, I mean to the big boys, right? To the firms and stuff. And so they sold it off, and all you heard about during earnings was like, oh my God, I still overvalue because earnings growth is post-compressed and all this other stuff, right? And then 2023 rolled around, and it was like, nope, fundamentals mean nothing. Boom, here comes the AI boom, blah, blah, blah. And think about it, even with the AI craze and this huge bubble, and that's what a bubble is. Right? The fundamentals go out the door, this bubble inflates because they're pulling so many earnings or so much of the earnings forward and saying, oh, they're going to make so much money off AI, right? Which is during the dot-com bubble. What happened? The internet was invented. By the way, put where you were at when first time you ever used the internet or even heard about it. I was in Okinawa, Japan. I was a Marine, and somebody said, I need to write a letter home. And they said, why don't you just send an email? And I said, what's that? And mind you, I'm from Troy, Alabama. So, we learned to type on typewriters, even when computers have been out for like 10 years. Okay. So, I was way behind the times, but it was the most amazing thing I'd ever seen. But everybody's like, people are going to make so much money, and all these companies IPO'd and all this stuff. And then everybody got frenzied and rolled into it. And then all of a sudden people realized, wow, they really aren't monetizing this stuff like we thought they could. Some companies did, and they were successful. A lot were not. And they imploded, okay? And that's just part of it. And so this AI is going to be the same way. They're pulling so much earnings forward, and eventually will come to earn at some point in time, whether it's 6 months, 12 months, 18 months, and they'll start doing earnings, and all these companies said, yeah, man, we're AI, woo, are not able to monetize it. And they're spending way more money trying to monetize it than they're getting in, so the bottom line suffers, and they go, wow, these companies are losers, right? But some companies will succeed, right? So that's one thing to keep in mind on that. But the question is on earnings is, when will they matter again? Right? Is it going to be the end of this year? Is it going to be next year? they always come back in where Wall Street goes, "Ooh, wait a minute, earnings really matter now, right?" And now this is what I want you to pay attention to. This is what you're seeing floating around the internet, and it could mean something. But the reason why the 618 area to the 65 area is so crucial, that area, is because we've seen this multiple times, right? You go to the 2000.com crash, huge rally up, right? Ends up coming up to that 618 area, and then what happens? Just collapses, right? So you get your sell-off. It fought for a little while, but ended up selling off. Then you go to 2008. What happens? Huge sell-off. Then, of course, here's the rally. Boom. Big rally up. Things are saved. Woohoo. And, of course, what's it reach? Ends up reaching the 618-65 area again. And, of course, what happens? It ends up going up there to that same area, 618-65 area, somewhere there in that golden pocket area. And then, of course, sells off, right? And then, boom, we crash and burn. Well, of course, where are we still at now? Here we are, big sell down, like 36%, huge sell down. And then here we are, retracing back up to this same area. So this is what gets to decide. I don't know which camp you're in. Like I tell people, don't be in any camp. And let me know what you think. What do you think is going to happen? Again, I'm not saying you can't compare this time to as far as the same things that were going on in each crash or anything. There was different things that happened. But understand, like in this time, that didn't happen in those times. We were at zero rates, right? Even when those stocks were crashing and we hit recession and everything else. This one, we have hit no recession, a technical recession, yes. We have never seen this kind of shortage in unemployment, in energy, in housing, now in beef, all this stuff like that. And again, we're in a high rate environment and a high inflation environment. So totally different. And quant funds and hedge funds and all these computers are running this whole thing, right? These algos. And so a lot different. But I always like to stay up to date and keep in touch with what's going on. It's okay, that makes sense if it does happen, right? So let me know where you're at, what you think is going to happen. Now, two stocks real quick to look at here. One is Tesla, big day, right? Always look at the ones that are going green, even on the days that are red or green, whatever. But again, it breaks above this trend line, and it can actually gap up tomorrow, believe it or not, even though you look at the RSI, I mean, this thing is really oversold in the hourly. MACD is getting stretched like crazy. But the reason why I can gap up, if you pull a volume profile on this thing to the right, you'll see it drop off quite a bit. And you look on the weekly, I mean, this thing has plenty of room to run. And if that MACD crosses that zero line, that is super bullish. And then you're looking at that next area I got on there for you, right? Then you get Amazon. I drew this arc. I don't usually do arcs, but I like to play around with them. I drew this arc probably back in March, maybe. And this thing has touched the sides like crazy. Again, you look at this thing, it bounced perfectly outside the arc multiple times. And again, I was telling you, you get these rounding formations in these stocks. And you can see it's turning that area, which was resistance, into support right now. That's what it's doing, which is good. Even though you can see that MACD looks like it wants to roll over on the daily. It does, and this is one of those stocks that when it gets overbought, you get a pullback. Like, it's not one of these high-flying tech stocks, right? But if we get a bounce right here, once it finally finishes turning that into support, yeah, you're looking at between 135, 140. I mean, that's what you're looking at. And tomorrow, you have NEO earnings, but you have no economic data. It's just sway anybody. But I will tell you, as I warned members yesterday, to keep you way ahead. Next week, what we got going on, make sure you understand CPI, FOMC meeting, and you have monthly OPEX, but on top of that, you have quad witching, okay? And so I've already sent all those definitions, all the dates out to the members. So, just understand next week is going to can be super volatile. There is so much going on packed in that week, right? And so just keep that in mind. We usually get volatility just off a monthly OPEX, but now you got all that in 1 week. Yeah, it's going to be some fun stuff, let me tell you. And again, let me know in the comments. I've been debating on this. Is like, I've been putting, instead of the Friday video, I've been putting the Friday video out on Saturday between 1:30 and 3:30 and everything. Because I feel like, you're Friday, you're home from work, you don't want to do anything with the market stuff, maybe the next day. But just let me know. I'll take a poll on it, stuff like that as well, and see what you guys think. Because I'm here for you, so either way it works for me. Either way, I still got to do the work. So anyway, if you got anything out of it, guys, hit that like and subscribe button. Let me know what you think about the interviews you heard at the beginning, what you think about those fib levels, where we're going and stuff. And are you in the bullish and bearish camp? Or are you kind of in the middle just going, not sure still which way we're going here. So anyway, want to put that out to you. Have a good one, and I'll see you either tomorrow or Saturday.